Hi there, this is Gabe Bodner, and I want to give you a brief update on what's happening in the market. There's a lot going on. Obviously, with coronavirus, there's a lot of uncertainty, a lot of concerns, and I hope, first of all, that you are staying healthy and that you're doing well in all of this, again, challenging and uncertain times. We will get through this. I'm pretty confident of that, and we all just need to stay strong and healthy, and we will come out of this okay on the other side. Um, Again, wanted to give you an overview of what's going on in the financial markets and as it relates to interest rates, because I'm getting a lot of calls and a lot of emails and just pure confusion, quite candidly. So what I've got on my screen right now that hopefully you can see is the Fed funds rate. And the Fed funds rate, or the federal funds rate, you can see uh, the Federal Reserve, when they met and they dropped interest rates by 0.5% earlier this month, you can see that that's indicated here. And then on Sunday evening, just this week, they announced they were dropping the rates all the way to zero effectively. So the Fed funds rate is currently at 0.25%. So what's interesting about that and how the Fed funds rate works and how it relates to the stock market, bond market, mortgages is what I want to talk to you about. So first of all, Fed funds rate does not have a direct impact on mortgage rates. So Fed funds rate has to do with short-term interest rates. Okay, mortgages are long-term interest rates, but short-term interest rates, credit card interest rates, car loans, home equity lines of credit. So you will see a direct impact on the prime rate, which is what most home equity lines of credit are tied to. So that's the Fed funds rate. As we look over at what the stock market has been doing in the Dow, we can see that in the last 30 days, the stock market has actually dropped by roughly 30% in the last month. Significant drop. This, as my screen just refreshed, excuse me, what normally happens, again, in a normal market, is as investors move money out of stocks, they move money into bonds. And when this happens, and clearly money is moving out of stocks, we can see from a percentage perspective, we're down 30% in the last 30 days. A normal market is that moving out of stocks and moving into bonds. As we look at the bond market and we look at the treasuries, okay, we can actually see here that in the last 30 days, okay, there has been a significant drop in the yield. Okay, so we saw a huge drop down to 0.569% was the bottom of where the 10-year treasury yield is at 0.569% on March 9th. We've seen it rally a little bit, come back down here just a few days ago, and now 3 days later, we're back over 1.1% on the market today on the one-year treasury. What does this mean, and how does it correlate? Mortgages, again, typically follow mortgage-backed securities. We like to believe that they follow the 10-year treasury index, so we like to see and watch what's happening in the 10-year treasury, but they don't exactly follow the treasuries. What it does follow is mortgage-backed securities. And the challenge that we've seen in the last 2 weeks is something that I have never seen before. In my 18 years in this business, I have never seen anything like what's happening now. Well, as we can see on March 9th, when the 10-year treasury plummeted and hit a record low, mortgage rates did follow, in fact. And we were seeing 30-year fixed rate mortgages, quite candidly, around 3.25% for conventional, good credit, low loan to value, all of that. So a really good vanilla cookie cutter loan around 3.25%. Okay. And then we saw rates actually shoot up to close to 4% just a few days after that. And then just a few days later, we saw interest rates come back down, and we were seeing rates close to around 3.5% again just yesterday. And now today, we're seeing rates over 4.5% right now. So why is this happening? I will tell you, I don't know 100%, but I can tell you this. With COVID-19 happening and with employees having to work from home or work remote, the supply and demand right now in the mortgage industry is out of whack, okay? there's roughly, okay, $11 trillion worth of mortgage debt in our country. As a society, we've got about $11 trillion worth of mortgage debt. As an industry, normal year, we close $1 to $2 trillion worth of mortgages as an industry. Okay. If interest rates have fallen to the lowest levels in history, the industry does not have the capacity or the bandwidth, nor the liquidity or the human power to handle 3, 4, 5, 6, $7 trillion worth of demand. It's just not there. Okay. So as interest rates have fallen and as the demand has increased, lenders quite candidly have artificially, for lack of a better term, increased interest rates so that we slow the volume. I know it's not the answer that you're looking for, and I know it's not great for everyone if you didn't time the market or lock into an interest rate when they were lower. But I will tell you that that's quite candidly what's going on right now. There are, again, the supply and demand issue, and COVID-19 has absolutely impacted the human element of being able to handle the demand. Quite candidly, without COVID-19, we still couldn't handle the demand. But because of it, it's just impacted the workforce that much more. As a company, I can tell you that most of our employees are working remote. As an industry, I can tell you that title companies are closed or working remote. In certain counties, I can tell you in Santa Clara County, California, as an example, that the county offices are closed. We can't, in fact, record documents with the county if the county offices are closed. So we've got a lot of challenges going on in the market right now. We've got a lot of moving parts. And in my opinion, I will tell you that we will see rates come back down. Again, that's my educated guess. I just think right now interest rates are inflated. I think that they're artificially inflated because of everything I've just mentioned. I do think that interest rates will come back down. To what levels, I have no idea. But I just don't think the economy is strong enough right now to withstand interest rates of 4.5%. We will see interest rates come back down below 4%. What they come to, I don't know. So all in all, be patient, hang in there, understand that we as an industry are doing everything we can, but it is a challenging time. So have patience and just know that if you are looking to buy a house and you are looking to refinance and you want to lock into a lower interest rate, get the process started. Okay, fill out the online application, start gathering your documents, and really talk to me or someone else about what your options are. And if and when rates get to a point where financially it makes sense for you to move forward and lock in that rate, well, then you're prepared to be able to do that. So hang in there. I'm available. Please reach out if you have questions, if you want to talk. But again, just stay healthy, stay safe, be patient. And if there's anything I can do for you, please do let me know. And just want everybody out there to remain calm and be patient with everything that we're dealing with. And look forward to following up with you real soon.